Thank you for joining our webinar today. I appreciate your patience as we get started. My name is Jean Gabriel. I'm the Marketing Manager with CliftonLarsonAllen. And before we get started, I'd just like to cover a few housekeeping items. If at any time during the webinar you have questions regarding the technology, there's a number on your screen, 1-800-263-6317. Go ahead and dial that number and we can help you. If you have questions on today's content, we'll address those questions at the end. We have planned for a Q&A session after the presentation, and those questions can be submitted via the questions function on the right-hand side of your screen. If you haven't already downloaded the presentation slides, we're going to send another copy of those slides as well as a webinar recording out to you via email in the next week or so. So we watch for that. And in addition, when this webinar is over, you will receive a survey from us when you log off the webinar this afternoon. We appreciate any input you can provide us. Your feedback really does help us build stronger programming for future events. If you'd like CPE for today's session, there are two requirements that you need to be aware of. First, you are required to respond to the polling questions throughout the presentation. And if you are in a group setting watching this webinar with others, you must complete a CPE sign-in sheet, including the attendance monitor signature, and return that to me within 2 business days. I emailed it out with a link to the presentation yesterday, but if you have any questions, my email address is on the screen. Feel free to contact me. You should have received, for those of you that are not familiar with us, I just wanted to give you a little information about CliftonLarsonAllen. We're a national accounting firm. We are structured to provide clients with professional industry insight, delivering audit, tax, consulting, and outsourcing capabilities from industry-specific perspectives. CliftonLarsonAllen has a staff of more than 3,600 professionals serving clients from more than 90 offices across the country. And with more than 50 years of experience in the nonprofit sector, we have one of the largest nonprofit practices in the country. We serve a wide variety of nonprofit clients, including associations, foundations, higher education institutions, religious organizations, and social service organizations. Without further delay, I'd like to introduce today's presenters. Our first presenter, Karen Grease, is a partner with CliftonLarsonAllen. She provides tax compliance and consulting services to nonprofit organizations. She has 25 years of public accounting experience, focusing on serving the needs of exempt organizations. Stephen Livingston has over 35 years of experience as a certified public accountant and also has a long history working with nonprofits. Steve consults regularly with the firm's nonprofit clients on compliance and reporting issues, as well as structuring for-profit activities. Melissa Dyer is a manager specializing in tax services. Melissa has over 7 years of public accounting experience, and her passion and focus is serving tax-exempt community. Her specialties include analysis, planning and reporting for unrelated business income, lobbying activities, foreign activities, and alternative investments. With those introductions made, I'd like to pass the mic over to Karen. Karen, would you like to start us off today with today's learning objectives?
I surely will. Thank you so very much, Jean. Our learning objectives today, what we're really looking to do is walk through unrelated business income, really starting with the foundation of walking through the definition of UBI, talking about the statutory exemptions and exclusions associated or available to us as we're looking at our revenue streams, really being able to understand and identify perhaps common sources of unrelated business income, and then as Jean mentioned, at the end, really allow ourselves 15 or 20 minutes to be able to answer questions that may have come up throughout the presentation. We're going to start off, as Jean indicated, with a polling question. And in this polling question, we'd like you to answer the question of, what is your primary source for keeping current with tax issues that actually impact your organization? And again, as this is the reason or part of the reason why we do these types of webinars, is many of you have indicated that you do rely on your public accounting firm as a resource as far as keeping up to date and current on issues that actually impact you as an exempt organization. Moving forward in the slides, as a general rule, what we look at when we're talking unrelated business income is just one moment, please. There we go. Whether you're a 501c3 public charity, maybe a C6 association, a labor union, a credit union, even our religious organizations, all 501c3 exempt organizations may have taxable income from the operation of a business activity or a type of activity that does not further your exempt purpose. And that income, net of expenses, would be taxed at corporate rates if you happen to be a corporation, or trust rates if you're organized as a trust. So all of us, as we work in the tax-exempt sector, should be aware of and really understand the rules and regulations surrounding unrelated business income. The compliance requirement associated with UBI is really such that when your unrelated business income is merely $1,000 or more, so a very low threshold, and you have a requirement to file a 990T. We all know that the IRS issuing the hospital report a few years back, the recently issued college university report had an aspect that focused on unrelated business income. The IRS work plan that's typically issued every year focuses on unrelated business income. But when our unrelated activity or the income generated from that activity is more than just a mere insubstantial part of our total activities within the exempt organization, the tax-exempt status of your organization may be of jeopardy. So as such, we all, whether we're practitioners or yourself within an exempt organization, whether you happen to be a finance official within the organization, a volunteer board member, or again, the leadership, the CEO or president of your organization, we all should be really understanding and be educated on the topic of unrelated business income and really understand the tests associated with determining UBI and be able to truly monitor revenue sources so we are in a position of having true compliance as it relates to unrelated business income. And with that, I will turn it over to Melissa Dyer, who will talk about the various definitions as it relates to UBI.
Thank you, Karen. So UBI defined is really a three-pronged test. We have to look at whether or not the activity is a trade or business, if the activity is regularly carried on, and we need to confirm that it's not related to the purpose on which the organization's exempt status is based. For example, a rental activity may be related to the organization's exempt purpose for some types of charitable organizations, but not other types of organizations. You have to meet all three of these tests for UBI to occur. But don't forget that you also have to look at statutory exclusions, which we'll be going over some of the common ones later in this presentation. So over the next several slides, we'll be going through each part of the test. So first, let's look at the trade or business. The first prong generally includes any activity carried on for the production of income from the sale of goods or performance of services by the organization. Typically, we're looking to see if the activity competes with commercial business activities. Having a profit motive is also something we would look at. But keep in mind, just because there isn't profit in the activity doesn't automatically mean the organization does not have a trade or business and meet this particular test. The next slide, I want to go over a couple examples of what trade or business could be. So in our first example, we have the regular sale of pharmaceutical supplies to the general public by a hospital pharmacy. So this does not lose its identity as a trade or business, even though the pharmacy also furnishes the same supplies to the hospital and patients, to the hospital for the patients in accordance with the hospital's exempt purpose. So the activity contained within a larger activity, the portion related to the sales to the general public would constitute unrelated business income. However, the portion of the activity related to the hospital using those pharmaceuticals for the patients would not be considered unrelated business income. The comparison I would draw here is that this pharmacy is competing with a CVS or a Rite Aid. The second example is soliciting, selling, and publishing commercial advertising. is considered a trade or business, even if the advertising is published in an exempt organization's periodical that contains editorial material related to the organization's exempt purpose. Let's move on now to our next polling question, and then we'll take a look closer at regularly carried on, the second part of the UBI test. So looking at the results, it looks like number 1 and 2 really close together, internal controls and healthcare reform. Thank you very much for your input, and we'll put this into consideration for future webinars we intend on holding. So let's look at the second prong, regularly carried on. We want to focus on whether the activity's frequency and continuity. Is the activity pursued in a manner similar to the commercial activity of non-exempt entities? This is consistent with UBI's primary purpose of placing an exempt organization's business activities on the same tax basis as the endeavors of a nonprofit business with which they would be competing against for this particular activity. Again, let's go over some examples for regularly carried on. So a couple examples of what we would consider not regularly carried on. A sandwich stand operated only for 2 weeks at the state fair. If we compared this to a for-profit sandwich shop, the for-profit sandwich shop would generally be open year-round. So the activity for just 2 weeks at the state fair would not be considered regularly carried on. Same with a fundraising activity that would only last a short period. When we looked at regularly carried on, an example we could use is a commercial parking lot operation. Having it be open Saturday all year round would be considered by the IRS to be regularly carried on, even though it's just 1 day out of the week. Something else you should be considering and be careful about is seasonal activities. For example, a snow cone stand or snowball stand. If an organization is running a snowball stand during the summertime, that's competing with other snowball stands because it's a seasonal business. So that would be considered UBI even though it is not for the entire year. So what about intermittent activities? In general, manner of conduct must be compared with the manner in which activities are pursued by non-exempt organizations. Where activities are conducted intermittently without competitive or promotional efforts of the commercial activities, they are not considered to be regularly carried on. So in our examples, we have casual sales of books by a college bookstore to non-students would not be considered regularly carried on because it's incidental to what's happening within the bookstore. However, when you have non-qualifying sales that are systematically and regularly promoted and not casual, they are considered regularly carried on. So if the college bookstore advertised off campus or encouraged sales to the general public, the activity would be considered, or that portion of the activity to the general public would be considered regularly carried on. So where the activity occurs so infrequently or such a short period of time, the activity will not be considered regularly carried on, even if they are conducted on an annual reoccurring basis. The most common example of this is your annual fundraising event that organizations generally have on an annual basis. So now let's look at the third and final part of the test, which is substantially related. So what is considered not substantially related to the organization's exempt purpose? To be related, a casual relationship to the achievement of exempt purpose must exist. The relationship needs to be substantial. It must contribute importantly to accomplish the organization's exempt purpose. An activity cannot qualify as substantially related solely because its income needed or used to fund the conduct of an exempt activity. Our focus is the activity itself, not what the net profits are being used for. So what is not substantially related? A business activity is not substantially related to an organization's exempt purpose if it does not contribute importantly to accomplishing that purpose. It must be a casual relationship to achievement of the exempt purpose, and relationship must be a substantial one when we're looking at the activity compared to why the organization has been granted its tax exemption. So here we have an example: operations of sports and fitness center is substantially related to a healthcare provider's exempt purpose, but the sale of items in its pro shop or used at the fitness center would not be considered substantially related to the healthcare provider's exempt purpose. The organization's exempt purpose determines whether an activity is substantially related or not. So it's truly a organization by organization, case by case analysis that would need to be done. The size and the extent of the activities involved must be considered in relation to the nature and extent of the exempt function that the organization is intending to serve. Activities that are related to the exempt purpose can still generate UBI if they are conducted on a larger scale than is reasonably necessary for the organization to perform its exempt purpose. In this instance, the portion that is in excess would be considered unrelated trade or business. Here we have the example of the museum, cafe, and snack bar that provides foods and services to individuals who are not patrons or staff of the museum. The excess of the sales would be considered UBI to the museum. Going above and beyond what is needed to satisfy the organization's exempt purpose is what we're looking for to ensure we do not have not having it be not substantially related to the organization. Up next, we do have a polling question, and then we'll have Steve take over to discuss some of the exclusions of unrelated business income. So the polling question: have you recently visited the new CLA website and taken advantage of additional resources? You can please select yes or no.
Thank you, Melissa. And as you all are answering it, and I have this picture in my mind of the pressure of the countdown to get the question answered. If you all are listening in a group, we hope you will participate in the polls also, so we get the entire group answering them. Again, my name's Steve Livingston, and we've got 15% as yes and 85% as no. And since I'm a member of CLA, we'd encourage you to check out our website. There's some really nice resources there, including some on healthcare, which I think was one of the big topics that you all wanted to hear about. Okay. I'm technology challenged, so we'll move it on and get used to this. I'm going to be talking a little bit now about exclusions from UBI, but I want to go back and just again summarize why UBI came into the tax code. What was happening way back is tax-exempt organizations were starting commercial enterprises that competed with commercial side, the for-profit businesses. And if you think about your not-for-profit, you don't pay income taxes. So federal, that's going to probably be, if you're in the top tax rate and you're a corporation, that's going to be 34%. You've got state income taxes, add another 8 to, or 6 to, probably 4 to 6%, 8% on that. And you're also exempt from sales taxes and a whole bunch of other taxes. So if there were complaints by the for-profit businesses that this competition wasn't fair, and it's really not. If a not-for-profit could conduct a commercial enterprise without the tax effect, you would have a 50% competitive advantage. And Congress just said, we don't want that to happen. So they enacted these UBI statutes. And then, as with any income tax law, they said, okay, well, we've got this set of statutes, but we're going to make some exceptions. We're going to have some exceptions for types of income. We're going to have exceptions for activities. And that's what these exceptions surround. And as I go through them, I think you'll see that there are differences in the way the activity is conducted or how it's conducted that that Congress decided to accept them. So the first one we talked a little bit about. If you do not regularly carry on the activity, it's not going to be a trade or business. And where I see this most often is the annual fundraising dinner. The organization holds their annual fundraising dinner. They not only have a dinner where they sell tickets to, they have entertainment, they have a silent auction, they hold it once a year. That's not going to be considered regularly carried on. An annual golf tournament is the other one I see a lot. Obviously, with an annual golf tournament, you're not competing with the PGA. They've got to hold more tournaments than that, and that's not considered regularly carried on. We did talk about those seasonal activities. Obviously, if you've got a ski resort and it's only open 4 months a year, as is all the other ski resorts in the area, that's going to be considered regularly carried on. One of the big exceptions that we see used is the next one, which I call the volunteer labor exception. Basically, if you're using just volunteer labor in the activity, it's accepted or excluded from UBI. Now, the question comes up, how many volunteers? Well, substantially all of the work has to be performed by volunteers. And that means more than 50%. Do we have an exact percentage? Probably not, but you don't want to be the one litigating it. So it's substantially all. That means most of your people conducting the activity are volunteers, and you have very little paid staff involved. An example of that out here, I'm out in Albuquerque, New Mexico. We have a balloon fiesta each year, and to get help with the parking early on, they had a C6 service club come in and help park cars, and they got a percentage of the revenue from parking cars. And it was quite a large amount and helped fund their activities. But that fiesta is only held for about 10 days, so they're not competing with other parking services, and that's excluded from UBI. Another activity that Congress decided to exclude is one that's carried on for the convenience of its members. That's a C3 type organization, and where I see these are, and examples are a college bookstore. A college bookstore sells books and other articles to students. It's an activity that's carried on for the convenience of those students. It is not generating UBI as long as it's just primarily or serving students. The other thing I see a lot is museums will have a cafeteria just for their patrons that come and visit the museum. Again, that is excluded from UBI. Then the next one that's on the screen is what I call my thrift store exemption. If substantially all of the merchandise being sold is received by the organization as a gift or contribution, that activity is not going to be considered an unrelated business activity. Big one we see is Goodwill. If you go into a Goodwill store other than it's used clothing, it doesn't look any different from another used clothing store operating in the community. But because the merchandise is received as gifts and contributions, that has been carved out, and you see other type thrift stores of other organizations. The next slide will show you a list of items that we're now going to go over in more detail. This is to perk your interest. The first one we're going to talk about is a public entertainment activity. Now, I'll tell you what this is this is a state fair or county fair exception. You go through and look at it. It's about a fair with agricultural type exhibits, things like that. It's your state or county fair. It's carried on by a C3, 4, or 5 organization. So out here in Albuquerque, we have what we call a state fair. And at that state fair, they do some additional things. They have revenue come in from carnival-type rides. They have horse racing that goes on during the state fair, and they also have concerts. All of those would normally be unrelated business activity except for this exception. So this is your state fair or county fair exception. The next one I call the trade show exception, and this again is certain types of organizations. So you have to be a C3, 4, 5, or 6. And again, you have to have a focus on education. So you can't just have a convention that doesn't focus on education. If it's just about selling products, it's not going to work. But you can organize your convention or your trade show so that it has a focus on education. It's educating public as well as members. So an example of this is, let's say you have a C6 solar manufacturers trade association. They hold a trade show each year, and in that they demonstrate the benefits of solar products and the different emerging technologies available to the solar industry. Lots of exhibits. Also, they have members that are displaying their products. That is going to be excluded and be treated as an exempt activity, and it will not be considered an unrelated business activity. The next one is one of my favorites. It's called a qualified sponsorship payment. Now, I want you to think college bowl games. I realize they're a little ways off, but this is what got this exception into the code. This exception came into the code back in 1997. It was part of the Taxpayer Relief Act of 1997. If you love reading code sections, you can go look at it. It's section 513 little I. What happened was, back in the 90s, bowl games started to get sponsors because it was becoming so costly to hold these bowl games, these college football bowl games. And we see them all the time now. The Fiesta Bowl is now the Tostitos Fiesta Bowl. The Cotton Bowl is now the AT&T Cotton Bowl. The Rose Bowl, because they're the granddaddy of them all, won't put the name before it of their sponsor, but if you go look at it and Google it, it'll be the Rose Bowl presented by Vizio. And then, of course, one of my favorites is this TaxSlayer.com Gator Bowl. Well, as this sponsorship started to happen, the IRS said, boy, this looks like advertising. There's big dollars involved. We're going to go after the tax-exempt organizations, and we're going to tax this income. It's unrelated business income. And this was back in the day when Congress used to work together and were able to compromise and come up with laws. Not that that's not the deal today, but we won't digress there. But what happened is in Congress is there were a lot of college bowl fans. There were a lot of alumni of large universities. Some of you that may go back then, some of the rivalries in the Big Ten when Ohio State and Michigan played, the delegations from each state would have friendly wagers, Oklahoma, Texas, many more of those. And Congress said, you're not going to tax sponsors of bowl games. So they carved out this exception, and when we go through it in more detail later, be thinking college bowl game, and you'll see some of the requirements that need to be met, such as you get your logo on the field, but you don't advertise your products on the field. But that's the qualified sponsorship one. Then distribution of low-cost articles. This is an interesting one in that many organizations, and it has to meet some requirements. It has to, first of all, be a low-cost item. I'll talk about what that is. You have to do it it has to be, the distribution of the article has to be part of a solicitation of a charitable contribution. So let's say you have an organization that encloses return mailing labels with their appeal for a donation. Well, as long as it meets the requirements and meets the low-cost threshold, it won't be considered an unrelated trade or business. They won't have to bifurcate the donation coming in and saying part of it's unrelated business income and part of it's a donation. Another example would be an organization that sends a box of greeting cards with its appeal for a donation. Again, as long as it's the low-cost threshold, it won't be considered unrelated trade or business. Now, what is low cost? Well, low cost started out when this provision came into law. It started at $5. It's indexed for inflation, so in 2012 it had grown to a whopping $9.90. Now, for us tax people, we kind of like that and wish it stayed that, because $9.90 was easy to remember because it matched the $9.90, but it didn't stay there. For 2013, it's $10.20. So again, in my two examples, as long as the low-cost article was less than $10.20, as long as the donor didn't request or expressly consent to receiving that article, and as long as each distribution or solicitation for the donation said that they could keep the article whether they donated or not, if it meets all those requirements, again, it's excluded from UBI. Another excluded activity is bingo games. There's a number of requirements that have to be met. The most obvious is they have to be legal under the state and local law in the location where they're held. You can't hold illegal gambling activities. It has to be a bingo game. That's, for those of you that have gone, it's the thing where you have the little card and that whole deal. And it has to be conducted where there's no commercial competition existing. So really, it's bingo games are held in a state where they said only exempt organizations can hold them, and then they have to meet those requirements. Now, you might also see some other types of games of chance that are held by exempt organizations: pull tabs, raffles, video games, poker, and lotteries. Lotteries is a big one. Again, it must be legal, so if you're going to hold a lottery in your area, you've got to find out what the requirements are. Most exempt organizations that have those, they do with unpaid volunteers, so they meet the volunteer exception. But one place where you can see it held, where it's going to qualify as substantially related to the organization's exempt purpose or where it could, is where you have a fraternal organization such as a large that qualifies under C10. They might offer, pull tab or other games of chance at the regular weekly meetings, and they comply with state law. It's legal, but they have to use paid staff members. Well, if you think about it, one of the exempt purposes of a C10 is providing social and recreational activities to members. So that would fall or could fall within that exception and not be treated as unrelated business activities. Other organizations that have that type of purpose are C7s, 8s, and 19s. If you'd like, when you get off the phone, you can go look at those. Couple warnings if there's game of chances involved is a lot of states have excise and other taxes on wagering income. Got to be in compliance with that. The other thing, just so you know, is wagering activities is a question on the 990, and the IRS thinks there might be some opportunity for UBI there. So if you have those kind of activities, I recommend you talk with your tax advisor, make sure you're not going to run foul of the law and have it be UBI and go back and have some challenges with that. Okay, now we have another polling question. So get ready, get your mouse ready. What is the greatest challenge facing your organization this year? And there's a set of 5 questions, and we appreciate your answers. Again, you have to answer for CPE credit if you're on the webinar alone and having your CPE that way. Okay, 33% feel that the greatest challenge is Obamacare. I think that probably that is the same percentage or higher in the for-profit area. It is one of those real big challenges facing all organizations in the U.S. Executive leadership succession, 26%. That's very interesting. In the for-profit area, business succession is a big topic. We find it also in the not-for-profit area. I know I have some clients that are not-for-profits where they were started kind of with family members involved in some of the management, and then getting succession on to another group of passionate individuals can be a challenge. Okay, well, we'll keep going on. Thank you for your participation. Okay. I'm going to cover a couple more that aren't on this slide, which is hospital services, which I didn't cover, and utility pole rentals. I'll go ahead and cover those now. We got a little bit out of order, but that's the fun of doing this. Hospital services, what you're talking about there is, and we have this in New Mexico because we have rural hospitals that are smaller, and then we have bigger hospitals that can help them. But what this hospital service exception is about is where you have a smaller hospital. Now, that's defined, and I believe it's a facility that can't serve more than 100 patients, where they need some help with some of their service activities, and they go get a larger tax-exempt hospital to perform these activities. As long as the activities themselves would be exempt function activities, if the smaller hospital would conduct them, that's okay. And then the larger hospital can't make this a profit center. They've got to make it cost-based in their pricing to the smaller hospital. Now, what type of services am I talking about? Well, a couple big ones. If you think about a smaller hospital might have challenges with all of the complexities of billing and collections that go on. So that might be something they use. A larger hospital that has a billing department might use them, utilize that help, and pay the larger hospital cost basis. Another one we see quite frequently is laboratory services. The smaller hospital just doesn't have the capacity to run the complicated laboratory tests, so they'll reach out to larger tax-exempt hospitals to help with that. Then one of the other excluded activity is qualified utility pole rentals. You might go, Steve, what in the world? Again, we have some of this out in New Mexico because who this applies to is mutual or cooperative telephone or electric companies. They can do some utility pole rentals and have it not be UBI. Okay, we have covered that polling question. Now we've covered activity-based exclusions, and I hope those make some sense, how they differ a little bit from a for-profit, how they're not competing. Obviously, a for-profit's not using volunteer labor in running their business. So that's activity-based exclusions. Now, there's certain types of income that are also excluded. And there's going to be later on some exceptions to these exclusions. So we have the UBI law, we have exceptions or exclusions, and we have exceptions to that, which we'll get to later, and it's one of the challenges with income tax law. One of the exclusions are interest and dividends. They're excluded from UBI. They're considered passive investment type income, not a trade or business. Rental income, that's really real estate rental income. If there's more than an incidental amount of personal property rental included, it can cause it to become taxable. We'll talk about real estate rental income later, but that's a big exclusion. Mailing list rental income, if it's between charitable organizations, can be excluded. Royalty income, if it's passive, again, we'll cover this later, it has to be passive, but that's not subject to UBI. There are some other types of mailing list rentals that qualify. If you have some of those, you can talk with your tax advisor. Another big one is gains and losses from asset dispositions. So when the organization sells some of their fixed assets, equipment, that's not subject to UBI unless it's in an activity that's a UBI activity. And again, sales of investments generally won't generate UBI. So when you start selling off investments and reinvesting, that won't be subject. And again, research and income, what that pertains to, if you're a C3 organization conducting research activities such as medical research, and you meet the other requirements, one of the research is available to the public through publication or whatever, then if you meet those requirements, that research income is considered exempt activity income and is not subject to UBI. So a couple of tips we have for you. You want to consider the source of the income. What is creating the income? Is it something that is competing with, it's an activity competing with other trades or businesses? Does it look like a commercial business? If the source is a commercial business activity or an unrelated business activity, it's going to create a taxable income situation with a 990T. And it doesn't matter that you're conducting that activity so you can use the revenue so you can carry on your exempt activities. It's not the destination that counts. It's what is the source and what's creating the income. Then the other thing that we'll look at later on is it a passive activity or not? Passivity usually or generally is a sign that it will meet an exclusion, because for the most part an active trade or business is going to require active participation. So it's kind of one of those things. If it looks like it's an active trade or business, if it's competing with commercial enterprises, there's a good chance you want to talk with your tax advisor to see if it is an unrelated business activity with filing requirements. And the filing requirements are both federal. A lot of states will tax UBI. You can have sales tax situations. So it's really something, if you're in this situation, you want to talk with your tax advisor. Also, there's opportunities to structure it so that it does meet one of the exceptions. Now I'm going to turn it back to Melissa, who's going to take you on here for a little while. Melissa, are you there?
I am. Thank you. And
okay.
It on. We're So now that we've discussed some of the exclusions, we're now going to look at some of the common sources of unrelated business income that an organization may see. First, what I'd like to talk about are exploited activities. An exploited activity, in certain circumstances or situations, activities carried on by an organization during the performance of their exempt purpose could generate goodwill or other intangible economic benefits, which are capable of being taken advantage of or otherwise exploited. When an organization exploits such an intangible while performing their commercial activities, the earned income that does not contribute to accomplish the organization's exempt purpose is called exploited exempt activity, which is deemed to be unrelated business income. So some examples of exploited exempt activities. Number one, and we see this often in our client base, is advertising. Also, if an exempt school has tennis courts that they use during the regular school year for education purposes, tennis classes, etc., but then they use those tennis courts for operating a club that there's membership fees during the summertime, that portion of membership fees would be considered an exploited activity and would be taxable to that school. Also, membership list sales to business firms where a service charge is made. We don't want to get confused with some of the exemptions Steve talked about earlier with royalty income with mailing lists. But normally this deals with a service charge and sending promotional items or articles to the member list. Finally, state-chartered credit unions, which generate income from non-member ATMs, insurance sales, car buying, and warranty services. Having these state credit unions have ATMs and members using these services are okay, but the fees that they charge for non-members would be considered UBI and reportable on the 990T. Another common source of UBI, which we want to drill down a little further, is advertising, because it is so common with organizations. The sale of advertising in an organization's periodical is one of the most common forms, as I mentioned, of an exploited activity in common form of unrelated business income. The sale of advertising exploits the exempt activity by using the circulation and readership of the periodical for commercial purposes, since the content of the periodical relates to the organization's exempt purpose. Consider whether the activity is regularly carried on, because when it's not regularly carried on, the income may not be taxable. So we really want to look to see how much time the organization is spending on getting the advertisers in place for their periodical, and compare that to what a normal marketing firm would do when they are getting ads in place for their magazines to see if the activity truly is regularly carried on. Also, we have to be able to distinguish advertising between a qualified sponsorship payment, which is something Steve touched on earlier when he was going through some of the exclusions, and something we're going to dig deeper into now. One other point I want to make on the regularly carried on for the advertising, Steve mentioned bowl games. I'm going to go ahead and mention March Madness. There was a case that went all the way up to the Supreme Court in regards to advertising and regularly carried on, where the courts actually did side with the NCAA in that the time spent for the advertising was not substantial enough to be considered regularly carried on, and therefore it was not considered unrelated business income. It is important to note that the IRS does not acquiesce to that case, but it is something that is out there when you want to look at regularly carried on and advertising. So advertising versus a qualified sponsorship. Qualified sponsorship payments, a payment by a business for which there is no arrangement or expectation that the business will receive any substantial return benefit for that payment. It's irrelevant whether or not the sponsored activity is related or unrelated to the exempt purpose. Again, a gala is a good example, or if a business wants to sponsor a hole on the golf course for the organization's golf tournament is another common example. So a substantial return benefit includes goods, services, other privileges, advertising, exclusive provider arrangements, which does differ from exclusive sponsorship arrangements, which we'll discuss on the upcoming slide. But before we get there, let's go to our next polling question. So, which of the following most accurately reflect your annual budget? And we have 5 choices here. We'd appreciate if you'd select one. Okay, it looks like we're most accurately reflect annual budget. Number 1, $1 million to $10 million. Going number 2, just a little larger than that, with a $10 to $50 million annual budget. It's nice to see that we have a good variety here on the webinar, and we appreciate that, and thank you for listening. Next, we want to continue on with qualified sponsorship payments and substantial return benefits. So what we keep talking about advertising, and let's define advertising. It's when there's an inducement to buy, where there's qualitative or comparative language, price information, indication of savings or value, some sort of endorsement for a particular product. And also I mentioned we were going to talk about exclusivity arrangements. An exclusive sponsor is not taxable and is considered to be a QSP. Going back to the bowl games, with the payment for Coca-Cola to be the sole beverage sponsor of that particular game is perfectly okay. It's considered a QSP and it would not be taxable to the organization. However, when you start looking at exclusive providers, that is not considered a QSP, so it does not have the same exception as the exclusive sponsor arrangement. So if Coca-Cola decides to make a payment to ensure that it's only Coca-Cola products and we don't have any other competing beverage products are sold at the sponsored event, that would not fall under the definition of a qualified sponsorship payment. Okay, so substantial return benefit, what does that not include? We've talked about some of the things that it does include, but here's a list of some common items that it does not include. So sponsorship's name, logo. You have banners that you see all over for the bowl games, or on the field you'll have the map with the sponsor's name on it and maybe their slogan. A lot of times organizations will acknowledge the sponsor for being a part of the event. An acknowledgement is okay, but if we get back to an endorsement talking about how wonderful a particular product is the sponsor has, then you get into a substantial return benefit situation. So you want to be careful in how the organization acknowledges the sponsors for being part of the particular event. Slogans that are part of the sponsor's identity, though, and that do not contain comparative, qualitative descriptions are absolutely fine and are considered to be a QSP. Listings of sponsors' locations, phone numbers, internet address, value-neutral descriptions are also okay. A lot of times you'll see the sponsor listings in the event programs for the event that is being held. Also, the brand or the trade names product listings. The display or distributions of sponsors' products by the sponsor or exempt organization at the sponsored activity is okay. Sometimes you'll have that if you're having a sporting event and you have Nike or Adidas sponsoring. They might show, if it's a football event, they might show the latest in helmet technology or pads for the football game, and they're just displaying their products, and that's perfectly okay to happen. Finally, the hyperlink on an exempt organization's website to the sponsor site. The hyperlink itself is okay as long as it does not contain any endorsements or promotions. Once you click onto the sponsorship home, you want the hyperlink to click to the sponsor's homepage and not click to an advertising type page or trying to sell a particular product. So next what we're going to do is we're going to talk about an exception to the exceptions, as Steve alluded to earlier in the presentation, and take a look and dive in a little bit further to debt financed property and debt financed income. So Steve, if you want to take it away.
Okay, back to me. I'm going to mention a couple things again about this qualified sponsorship, just because I kind of like it. If you notice at the bowl games now, almost always they'll have an executive from the sponsoring company get on and thank the participants and talk a little bit, but they aren't selling product, and that's perfectly okay. Now, that's the big bowl games, but I can tell you that many of our organizations are now holding fundraising events, and they want sponsorship dollars. So, for example, we have a client here that has a kite contest, a kite flying contest that raises money, and they do sponsorships. And they've structured it so that it meets these exceptions and raises revenue for them. Other activities, fundraising that I've seen clients hold are a thing like a fun run where they get some sponsors. And again, as long as you structure it into this exception, you can have it be a fundraiser, it can generate revenues for your event, and it's not subject to unrelated business income. So those are just some thoughts. I don't know if all the people on this webinar have the same challenges, but fundraising and revenue raising is a challenge in the not-for-profit arena is what we have seen. Okay, debt finance rental. Now, if you'll remember, I talked about earlier that the rental of real property is statutorily, it's excludable from UBI under the code, under the statute. And for example, we have a client here in Albuquerque who owns a very valuable piece of property on a corner that is one of the most heavily traveled corners in the city of Albuquerque. Towards the back of the property, they have their facility. They have parking in front of that. And then they have additional street frontage where there's some buildings been built, and there are restaurants that are in those buildings, and those buildings are rented to the restaurant. Well, that is the rental real estate. There's no debt financing, so that is non-taxable to that tax-exempt organization. Now, if you have too much personal property involved, or if you're only renting personal property, that won't work. That's UBI. If you structure your rental, I just gave you an example of a client that it's not UBI. If they redid their rental agreements with the restaurants and they said, hey, here's what we're going to do. We're going to charge you base rent of X amount per month plus 2% of your gross sales. That will cause it to become UBI because the rent depends in part upon the income of the person that's leasing the property. So again, it's about structuring the lease appropriately and so that you can get out of these rules if it's not debt finance real property. In other words, you don't become subject to one of these two. Now, if it's debt finance property, it's going to be subject and considered UBI. So what is debt finance property, rental property? Well, it's rental property to produce income, including gain on disposition, where there's something called acquisition indebtedness on the property at any time during the tax year, or you can't try and pay off the property, wait 3 months to the next taxable year, and then sell it and get out of this rule. I mean, there's some time frames here. But let's talk first about what is acquisition indebtedness. So acquisition indebtedness, like it sounds, is debt incurred to purchase or improve the property. You have to have that kind of indebtedness on it for it to be debt finance property. So let me give you an example again. Let's say that client I talked about who has this property free and clear, the rent to the restaurants, the lease agreements are structured properly, straight rental real estate. Let's say they want to build a facility up north in, let's say, Taos, New Mexico. And they need to get some financing to do that. And in order to do that, they've got to secure that financing by the property here in Albuquerque. Well, by securing their Albuquerque property with financing, does that make it debt finance property? The answer is no, because that indebtedness wasn't incurred to acquire or build upon the property that it is secured by. So those are just some things to watch out for. You have to dig a little deeper. It's just not if there's debt secured by the property, what were the debt proceeds used for? Okay, let's say we figured out that they incurred some debt to buy the property, they're leasing that property, and we know it's acquisition indebtedness. That makes it unrelated business income. Then what happens? Well, what Congress did when they wrote this into the code, and again, if you think about what's causing, why is debt finance property considered trade or business unrelated business income? Well, again, we were going back. We talked about, does it compete with commercial trade or businesses? If you think about real estate rental businesses, what do? They leverage the property. They are debt financing the property, renting it for a while, and selling it at a gain. That's why I think Congress said, if you're renting real estate that's debt finance, acquisition indebtedness, you're more like what's happening on the commercial side. We're making it taxable. So we say, okay, we've got acquisition indebtedness. Now what's the next thing we do? Well, we have to go through a formula, and this is in the 990T. We have to go through a formula to determine how much of the net rental income is taxable. And that formula is on the screen. The first one is the numerator, and that's the acquisition indebtedness. So we take the beginning of the year balance, principal balance, end of year principal balance, add the two together, divide by 2, and that's our numerator. Then we take the adjusted basis. What's the adjusted basis? It's the depreciated basis at the beginning of the year and the end of the year. So, and then take an average. So if you make additions to a property, that'll go up. If you don't make any additions, the depreciation will take that down. But that'll be a number. That's your denominator. Let's just say for simplicity that your average indebtedness on the property is $1 million and your adjusted basis average is $2 million. If I did my math right, that would make 50% of the gross income from the debt finance property would be unrelated business income. You get to take half of your expenses off of that, so you'd have property taxes, interest, depreciation on the property. 50% of that would be deducted to arrive at 50% of the net income from the property would be subject to unrelated business income tax. And again, that's in the 990T, and you perform these calculations, and then to the extent you have income, you're going to pay some tax on it. Okay, we have a polling question. Oh, I just lost the polling question. There it is. What is the biggest struggle you have with filling out a Form 990 if you do the 990? I guess the other question would be is if you provide information and data to your tax advisor to prepare the 990, these also may be the same things you struggle with. So we'll wait a minute here and see what your challenges are. As we're waiting for the results to come up, I just wanted, there they are, but I'm going to mention again, you are able to ask questions through the, there's a little access bar, I think, off to the side on your computer, and we would welcome your questions. We are going to leave 20, 30 minutes at the end for question answering. So we hope you'll submit questions if you have them. 31% said other, so that leaves a lot of interesting questions out there. I know for some of our people that have practiced more in assurance, the other struggle may be just opening the tax software. Now I'm going to get a bunch of calls from them this afternoon, but that's okay. Compensation reporting, that is a challenge. I think it's a little easier now because at least we get to use the W-2 wages for a lot of the comp reporting, and then benefits and retirement contributions can be estimates. I think that's made it a little easier, but it's just a whole lot of detail, and it's also something the IRS is looking at. And then number 3, which is I'm hoping this is helping you some, is unrelated business income. And it is a challenge not only because, well, one of the reasons is for every law there's an exception, and to the exception there's another exception. So we thank you for your responses, and we will move on to some exceptions. Okay, what are some exceptions to debt finance property? If substantially all of the property's use, 85% or more is considered substantially, is related to your organization's exempt purpose, the property is not treated as debt financed income. And what this formula looks at is it looks at two components to figure this 85%, or you can use two components: percentage of space used and percentage of time used. And just to give you a little example of where this has come in, where I've seen this is, I've seen universities and schools where they're out during their summer session, and what happens is they want to allow, let's say, a for-profit university to use their classrooms for 2 months out of the summer. And it's just a few of those classrooms. Well, if you go in and look at time usage and you look at square footage, it'll usually fall underneath this 85% and therefore is not considered UBI, even though your facility is financed with debt. So that's one of those exceptions that you can look at where you just rent out. It can also be just renting out one office in your big building, and that's only 2% of the building. That's not going to be UBI, even though you have debt on the building. Then that property used in unrelated trade or business, that's really misleading. If you're renting space to a thrift store that qualifies under the thrift store exception, so it's an exception to the unrelated trade or business, your rental income is not going to be considered UBI, even though the property's debt financed. So if the activity held in the building is an exempt activity or qualifies under one of these exceptions, the income generated, rental income, is going to be deemed to be exempted also. And then this property use in research and certain excluded activities, that we're getting back to that research exception. And if the organization's conducting an exempt research activity, renting the property to them isn't going to be considered UBI. Another area that I run into quite a lot is where you have one exempt organization related to another exempt organization. Now, they're both exempt organizations, and one exempt organization is renting the debt finance property to the other exempt organization. Well, let me just give you an example. We have a client who has put the properties, their homes and facilities into one exempt organization, and they put them in there for liability reasons. And those homes are rented to the other exempt organization that's related, whose exempt purpose is to provide vocational training and independent living services to those with disabilities. While the one organization's renting group homes, that's enabling the other organization to perform its exempt purpose, that's going to be excluded or not treated as UBI, even though the property is debt financed. Medical clinics, you'll see this what this has to do with, let's say you have an exempt C3 hospital, builds their hospital, then they build a building next door, they lease it to an unincorporated, then unincorporated, not the key, but rented to a group of physicians to operate a clinic on behalf of the hospital. That's part of their exempt purpose. That won't be debt financed income. The life income contracts, that has to do with, you see this a lot in universities, that I can go and contribute $1 million to a university on and get back an annuity that will pay me a certain amount over my lifetime. Well, if you think about it, university got $1 million, they go invest that, they have debt on that, which is the contract to pay me for my life. Well, those are excluded. Those don't generate UBI to your university. The next one that's an exception that we run into is called the neighborhood land rule. Let's say you're an exempt organization and there's a piece of property right next to you that's got a couple old dilapidated buildings. Let's just say they're leased to the city to maybe run to do some maintenance on their vehicles, and there's this property next door, and it's just ideal for you to expand. And somebody else owns it and is renting it to the city, and they put it up for sale. And you go and you look at it and you go, boy, I want to buy that property. It's right next door. Gosh, there's a 3-year lease. I'm going to have to debt finance it. Is that going to cause me to have unrelated business income over that 3 years till the lease is terminated? But I'd really like to do this because it's going to give me 3 years of income to help me pay down my debt. It's going to take me 3 years to get the architectural drawings, and I could go on and on and on. It's next door, so we know it meets the neighborhood land rule. If you go demolish the buildings and you turn it into exempt purpose within 10 years, it will be excluded from UBI under this neighborhood rule exception. Again, you've got some things you have to, some hoops you have to get through. One is you can't make improvements to the property while it's being leased. Another requirement is, besides the neighborhood part of it, is that you have to demolish the buildings that are being rented on the property prior to constructing your own property. You have to do it within 10 years. Special rules, a religious organization, they have church has a 15-year window. And the other thing that has to happen is if you can't get it converted within the 5 years, you have to ask the IRS for a ruling and prove to them that it's more likely than not you're going to convert it within the 10-year period, or you start reporting the UBI after your 5-year period runs out. Now let me give you some other examples before we go into the next set of slides. I covered debt finance real estate. Another place you'll see this is if the exempt organization is invested in a partnership that is invested in debt finance real estate, commercial real estate, that's going to generate debt financed income to that exempt organization. So you've got to look at the K-1s. Another place where you can run into debt financed income where it would otherwise be excluded is interest, dividends, capital gains. If it's debt financed, so if you have margin interest, or if you invest in one of these alternative investments where they're borrowing funds to buy the investments, that's going to generate UBI, and you've got to look at those partnership K-1s to know if you've got a filing requirement. And we'll talk a little bit more about that in just a minute. I'm going to cover one more exception, one more statutory exclusion, that's royalties. Royalties, if you structure it properly, it's not going to generate UBI. And what a royalty is, it's the use of an intangible right like your name or logo. The key here is that it's passive. So it can't be related to debt finance property. It can't be royalties from a related taxable controlled organization. And your royalty agreement has to be passive. You can't render more than a de minimis amount of services as part of the agreement. Real key to this not being taxable is the structure. Credit card affinity programs are where I see this the most. The IRS went after it. They went after some organizations that were big enough to litigate it. Some of those are like the Oregon State University Alumni Association, Sierra Club, Common Cause, Planned Parenthood Federation of America. And through these cases, it's carved out to where if you have one of these credit card affinity programs, you don't render any services in connection with it, you can get it to a place where it's not UBI. But again, structure is important, so if you're going to do this, I recommend you get your tax advisors involved. Now we are going to go to our next polling question. While we're doing this, we are going to transfer it back over, I believe, to Melissa. The question is, who prepares your Form 990 and 990 or 990T? And Melissa, I believe we're going on to you, right?
We are, thank you. So
you're welcome.
If everybody could just take a couple minutes and respond to this polling question, we'd appreciate it. Okay, so the clear winner here, the clear number one, is that most of the 990s or 990Ts that your organization is required to file are prepared by a CPA firm. Self-prepared, 21%, and then other 4%. I wonder what the other is. Maybe not required to file either form, perhaps. So the next topic I'd like to talk about is alternative investments. It's important for organizations to be aware of the potential additional tax implications that may arise when they decide to invest in such things as alternative investments. For example, investment in partnerships. The activities conducted by the partnership flow through to the tax-exempt organization and retain the same character to the exempt organization partner, and that's within the partnership. So trade or business activities would be taxable as UBI, passive income would be excluded. As Steve mentioned previously, you really have to look at that look at that K-1, because you need to see if there's debt being allocated to the exempt organization and if that debt relates to the passive income that is being reported on the K-1, because that could trip one of the rules, and then that passive income could potentially be UBI to the organization that flowed through from the partnership. You really want to look at the activities within the partnership and compare them to the exempt purpose of the organization to see if the activities align and if the organization has unrelated business income. Partnerships do often generate UBI for their exempt partners, and you need to remember that you need to review the entire K-1 to determine whether UBI is generated. A lot of times the preparer of the K-1 will report the UBI activity in box 20 with a code V on the face of the K-1, but other times you want to make every time you want to make sure that you dig into those footnotes of the K-1 to make sure you're not missing any types of disclosures or additional information related to the unrelated business income that the partnership may be spinning off. So we talked about partnerships. An organization may also choose to invest in an S corporation. Now, an S corporation, all amounts are considered unrelated business income that are flowing through from the S corp to the exempt organization, even if it's purely interest income and there isn't any debt associated or assigned to the exempt organization. So you want to be careful in structuring and entering into these types of investments to make sure you're carefully reviewing the potential tax consequences based on the investment vehicle the organization chooses to use as corporation, a C Corp, blocker corporation, or a partnership. Give it a minute. Okay, so when you look at alternative investments, you just can't look to see if the organization would be anticipating a K-1 from a flow-through organization. From the flow-through investment, you also have to consider other types of UBI implications aside from federal and other filing implications that may arise due to the organization investing in these alternatives. For example, most states also have their UBI rules, and so understanding nexus and apportionment are critical in determining if the organization has state for-profit filings that are required, and apart from solicitation requirements that might be needed within the state. And sometimes I've seen it's hard to obtain UBI allocations for states, so sometimes you have to work with the investment broker and also work with the potential preparer of the K-1 to try to dig in and get the appropriate information to do the analysis to see what states, if any, the organization is required to file. And then there's other filing requirements that are disclosures that the IRS is interested with Forms 926, 8865, 5471, 72 FBAR filings. There's significant penalties for noncompliance. These forms are required for the organization to report investments in foreign partnerships. If the organization chooses to make an investment in a foreign corporation and they invest over certain thresholds, they're required to file these informational returns to put the IRS on notice that these are where the funds went and this is what is in the organization's portfolio. So some tips: be sure to understand the legal structure of the alternatives that the organization is considering to invest in. It helps you to know what foreign filings, if any, are required, and if the organization should be anticipating a K-1, or if the legal structure is such that the organization would only receive a dividend, which would then be non-taxable, assuming there isn't a debt component related to the investment. Also, carefully review the footnotes of the K-1 for details on reporting obligations, because sometimes with these foreign filings, those requirements flow through and are noted within the footnotes of the K-1s. So there could be additional filings from what the partnership invested in that flows through to the organization, and that creates maybe a 926 filing or 8865 filing for a partnership or a corporation investment indirectly through the organization's alternative investment. And I think now what we're going to do is we're going to turn it over to Karen so she can talk about a couple upcoming events and the next couple of slides. Karen, are you there?
I sure am. Thank you so very much, Melissa. What we'd like to also mention, we have quite a few, when we look at the attendee listing, quite a few foundations that are on the call, and we'd like to tell everyone about our second annual National Foundation Conference, which will be held in Las Vegas. We'll be covering tax, internal controls, management, various types of topics, accounting matters during the conference, and I'd really encourage you, if you are interested, visit our website and consider signing up for the conference. You know, one item I also wanted to mention, I know that we have quite a few religious organizations on the line participating in the webcast. And many times, although our churches and our integrated auxiliaries don't have to file a 990 per se, separation of church and state, unrelated business income tax rules do apply to those types of organizations. So when an entity has advertising revenues, rental income, many have alternative investments. Religious organizations also have to make certain that they are, in essence, giving consideration to UBI and whether or not there is a 990T filing requirement for federal and also a state counterpart. It's not uncommon for many of our religious organizations to perhaps receive a donation of real estate, and maybe there is debt associated with that property or an apartment building, or maybe it is another building or property that is adjacent to the church, and they are renting that out for non-mission related purposes. All of those types of examples could give rise to unrelated business income. To really, I'll say wrap up the presentation and really talk about the revenue is only one aspect of analyzing and really looking at your unrelated business income. What's equally as important is once you've identified the revenue, is it's not only the revenue that's reported on the 990T, but it's the proper allocation of expenses. So as much as we first have to identify the revenue to determine what is required to be included or in the calculation of UBI, we have to make certain that we're going through and properly classifying and allocating expenses, because that is really the key to minimizing any potential tax liabilities. What expenses can we deduct? We can deduct those expenses that are direct expenses as it relates to generating that unrelated business income. So as Steve was talking about debt-financed rentals, real property rentals, expenses associated with the interest on that building, maintenance on the building, depreciation on the building, those would all be direct expenses that we can offset the revenue. But also the indirect expenses may be deducted against the UBI. So maybe it is your finance department that is spending time going through computations and calculations as it relates to those revenue sources. Or you happen to be a college that is renting out a portion of the facility to outside businesses to hold meetings. It would be going through those indirect cost allocations to really minimize the expenses. I know that if you happen to ever, look at the college university report that the IRS issued over the last year, and I'd really encourage all organizations to go out and look at that report because it has a lot of good tax information that the IRS is looking for as it relates to exempt organizations, and not just entities that are practicing in the higher education space. But what's really critical is that when you're looking at the expenses, that you really go through the process and develop a reasonable basis or a methodology that is used for that allocation. The allocation should be reasonable. It should be documented so that in today's world, if you have an IRS agent that may come visiting, or even if you have somebody from a state Department of Revenue, if you're under a state audit, you have the documentation to be able to let that be the starting point from which you go through the computations and calculations of determining what is your unrelated business income that's going to be subject to federal and possibly state tax. Some general tips we wanted to cover just basically in closing. It's very important that as an organization you truly know and understand all of your revenue sources, that you understand the revenue, how it ties to your exempt mission, or if it is revenue that's outside of perhaps your core competency or your exempt purpose, you're really making the linkage of whether or not there are exclusions that Steve spoke of that would say this income is not taxable. Is it, in essence, revenue that's generated from, again, the cafeteria in your museum, and it's mainly patrons that are attending or utilizing that cafeteria, and that would be an activity that would be excluded under the convenience exception? Or is your gift shop or your cafeteria within the museum, do you receive much by way of off-the-street traffic? Off-the-street traffic, and you advertise to the public. So you do recognize the fact that that cafeteria is being utilized by the lunch crowd of local businessmen or business people within your community that may be subject to unrelated business income tax. When you have the alternative investments, and I really don't like that word alternative investments because so many of our clients and exempt organizations now have alternatives, they have equity investments, partnerships, as just a regular investment within their portfolio. You really need to know and understand that legal structure. You need to read the footnotes, financial statements, attachments to K-1s to really understand the proper treatment. And as Steve and both Melissa indicated during the course of the presentation, it's really recognizing the fact that it is the source of the revenue that was key when we look at UBI, and not the destination or what that funds are actually used for that determines whether the revenue is tax-free or if it is taxable as unrelated business income. So with that being said, we have one more polling question before we do go forward into our Q&A portion of the presentation. And this polling question is really asking, what industry does your nonprofit most align with? So we'll take a couple moments to answer the question. As you can see, based on the results, is many of the attendees that are attending the session are really organizations that have common or commonly see unrelated business income. When we look at our social service organization, membership organizations, higher education, all types of entities where unrelated business income is not uncommon. And really understanding and reporting it is really key to compliance. As an exempt organization, many times it's not always easy to do the right thing, but we really hold ourselves out to be, stellars within the exempt organization sector, to be the cornerstone of the nonprofit sector, and we really want to ensure compliance in this area. With that being said, I know that throughout the presentation we've had some questions, and I'd like to just move forward into our question-answer session. I know that one question that was submitted, and I'm looking at it now, is asking the question of when you have multiple rental properties, are you required to separate each of the rental properties and really track the revenue and track the expenses separately for each property, or can you combine them together and report as one type of activity? Perhaps, Steve, do you want to address that question?
Sure. I was thinking of saying no, Karen, and I see what you did, but no, I'll address it. Where you have more than one rental properties that are debt financed, you want to do your calculations separately because each one will have a different percentage. And so you want to do each one of those separately and separately calculated. And you may have some of the rental properties that aren't debt financed, so they're not going to be part of the calculation. And then you'll have others that are. So our recommendation is you separate them out, which is what we do. Calculate revenues and expenses for each one. Calculate your business percentage, which is the average debt, your numerator, average basis is your denominator. Make that calculation and then report it accordingly on your 990T. And if you'll notice on 990T, there's the ability to report more than one property.
Thank you, Steve. Another question that was posed, and I think this too is maybe a question on the section that you discussed, Steve, is whether or not selling your used equipment is considered unrelated business income. And as a follow-up to that, what about investment income, sales of investments?
Okay, used equipment will not be UBI unless that equipment was used in an unrelated business activity, then it might. But most organizations, they use up their equipment, and then they go out and sell it, and then buy new equipment. That will not generate UBI. Investments is another big one. If you sell investments, those gains will not be subject to UBI, with the exceptions we talked about, and I apologize for these. You probably scratching your head. If the investments were bought using debt financing, so they were acquired on margin, or they're part of a hedge fund where debt is financing the acquisition, then that's going to generate both the interest and dividends will be taxable, and the investment gains and losses will be taxable. But what we see with most of our tax-exempt organizations is they just have equipment, they sell it, they have investments that are not debt financed, they sell them at gains. That will not produce UBI. Both of those fall under that asset sale exception.
Okay, thank you very much. I think there's another question. Steve, we seem to be focusing on you, another section that you talked about. I believe you were talking in the presentation about the hospital pharmacy example. And were you actually saying during that presentation that all sales to the public are subject to unrelated business income? or is that not the case?
Well, actually, that was Melissa. So, Melissa, do you want to take that one?
Absolutely. And so, yes, sales to the general public with the pharmacy that's within the hospital would be considered UBI. However, those sales that are furthering the hospital's exempt purpose with the prescriptions going to the patient that the hospital is caring for would be considered part of the hospital's exempt purpose and therefore not UBI.
Wonderful. Thank you, Melissa, and I apologize for that. Another question that came in asked whether or not you have to report any unrelated business income or if there's a threshold you have to go over before you actually have to report that income on a 990T. Do you want to answer that question, Melissa?
Absolutely. The answer is yes, there is a threshold. As I believe you may have mentioned earlier, the threshold is $1,000. There's a question specifically on the 990 within the core form asking if the organization has had UBI in excess of $1,000, and if so, the organization would be required to file Form 990T in addition to its 990 if applicable.
Karen?
Yes, sir.
Steve would like to also mention that's a gross income test, not a net income test.
Perfect. Thank you very much for clarifying that. Steve, when you were talking about the exclusion that related to organizations where, what we were looking at is substantially all or of that work is performed by volunteers, so you're looking at the volunteer exclusion. I know you spoke about a 50% threshold, but is there a percentage threshold associated with that volunteer exclusion when you talk substantially all?
Karen, I would have to look that up, and you may know that. What I am used to is a activity that is 80% or more volunteer and just has one or two staff members that kind of manage or oversee some of the activities. That's what I'm used to, but I can't remember if there's a bright line test or if there's been some litigation, but maybe one of you remember.
I believe it is when we're talking, the volunteer exception or even the donated merchandise. I believe both of those, if I'm not mistaken, do they not rely on like an 85% or more? So again, it's something that we can look up and follow up with once we are asked the presentation. We mentioned during the presentation as far as a cafe within a museum would not be considered unrelated business income because it is in essence serving the patrons. But the question was raised, what about the gift shop within the museum? That type of exploited activity. Melissa, I believe you spoke on exploited activities. Do you want to address that question?
Absolutely. Things within the museum gift shop that furthers the museum's exempt purpose, I believe, would not be UBI. And you'd want to look carefully at the other things that the museum is selling to ensure that it is furthering the exempt purpose or is a convenience to the patrons and employees of the museum, and to analyze whether or not those items being sold would be considered UBI. Karen, would you tend to agree?
I would totally agree. It's the same type of analysis that we look at within our museums, within our college and university bookstores, is really looking at what is being sold within that gift shop and then making certain it does tie to actual mission. We're seeing more of this even within our exempt organizations, within our religious organizations, that the church may itself have a gift shop, and the same type of analysis.
Karen?
Yes, sir.
This is Steve again. I'll give you an example because we actually have a museum here in New Mexico that has this very question. They sell, it's a museum that's an art museum, and they sell a lot of art prints that further their exempt purpose because it has to do with the same type of artwork that is in the museum. It encourages and attracts people to the museum. It furthers the art purpose of the museum. And then they also sell some jewelry that has nothing to do with the exempt purpose of that museum. So the jewelry sales are taxable and they're UBI, and then we have to go through some calculations to figure out what percentage of the store is towards those jewelry sales and things like that. So that's an example of a museum a gift shop in the museum where we have both unrelated business income being generated and also exempt income.
Thank you. I believe also, Steve, you spoke regarding gaming-type activities or bingo. An organization raised the question because they are a C3, a charitable organization that really serve the homeless within their community. And they actually have a raffle. And they have a significant prize going to the winner of that raffle. But the revenue that they're generating is very significant, perhaps in excess or close to $1 million. Is that income subject to unrelated business income tax, the proceeds from the revenue connected with a raffle?
Most of my experience says we have clients that do this. We actually have a client that raffles a Lexus, so it does generate a number. I'm not advertising Lexus, let me say that right now. It does generate quite a bit of income. And it is not UBI. It's not a regularly carried on gaming activity. So we take the position it's not UBI. However, let me give you this one caution. If you're doing a raffle, and for example, raffles in New Mexico are considered a gaming activity, and there's certain steps you have to take in order to not have it be an illegal activity, and you have to really be careful on. I'm just going to caution you there, because the last thing a C3 or a tax-exempt organization wants to be in is the paper in their community that somebody was arrested holding an illegal gaming activity. So you really want to comply with the state law in your area. But one raffle a year, a couple raffles a year, some of those silent raffles at your annual dinner, those are all going to fall under one of the exclusions and not generate UBI.
Right.
If I may add to that?
Yeah,
Karen? Okay. As Steve mentioned, and I echo, be very careful with the state registration requirements, but also I think organizations should be aware of the potential additional federal filings that may ensue from the person who wins the raffle money or the value of the car. So just something to check into, to look into, if a raffle with considerable numbers such as these, the organization does hold.
Thank you. Thank you. Very well. Very good point. Another question as we talk about exploited exempt activities. We talked about advertising within a publication, and we many times think in terms of our typical paper publications, but what about advertising or online advertising that may be contained within a website, so much of what we see currently? Are you finding that you also treat that advertising as unrelated business income, Melissa?
I am. Advertising, whether it's in a periodical or within the organization's online website, is statutorily considered unrelated unless you're able to perhaps say that the time spent, that it's not regularly carried on. But the general rule is advertising is considered to be unrelated.
Okay. What about when you're looking at allocating costs against that income? So many times when it is a periodical, we do, in essence, go through the computation that talks about readership costs of that magazine and really offsetting expenses in that manner. Do you go through a similar computation, or do you feel that some of the costs associated with the website is allocable against that revenue?
I would say there would be some indirect costs related to the website that would be able to be allocated to the revenue to reduce the unrelated business income.
Right. And I think so many times what we're finding is those organizations that are going down to more of a virtual, looking at having the information on the web and not, in essence, going through U.S. Postal Service and all the hard costs associated with a paper periodical, that those activities are truly very profitable. So we're seeing taxes being owed on those activities. Another question, if I may. If a nonprofit has land and there happens to be a cell phone tower on the land or the building, and the building itself is debt financed, would you consider that cell phone tower itself being unrelated business income? Steve, I don't know if you want to take a stab at that.
I'll take a stab at that. If I have real estate that's debt financed and then I build a cell phone tower on it that I don't incur debt financing, I might take the position it's not debt financed property. However, it's on debt financed property, and you might lose on that. So I would recommend you talk with your tax advisor, and you may want to look at some of the case law and see if there's any examples like that. I can tell you we have a few clients that have cell towers on their property, but it's not debt financed property, so I haven't had to look it up yet myself. Karen, have you, or Melissa, have you seen that?
Not recently. I have not seen that. I know that, many times you have to be so very careful and then just ask the question of, is this cell phone tower that's attached to real property, is that deemed to be personal or real property? Another question, if we may. A person we just wanted some clarification to that regularly carried on component. And just asking the question, Melissa, is that if a client has an annual periodical and that periodical maybe only has a minimal amount of advertising, maybe there's only 2 advertisements in that periodical, and it is only published, one time a year, would you view something such as producing that periodical with 2 ads as being taxable? Or would you say that may fall into that not regularly carried on?
I would say that may fall into that not regularly carried on. The question I would have is how much time and resource does the organization spend to get those advertisers to put ads within the periodicals? And if that's very minimal, then I would think it would not be regularly carried on.
Okay. Another question. A question from a theater, and I guess this could apply to many different types of organizations, is they rent their theater to other entities, maybe have outside events, rent to brides, rent to businesses to come out in and use their theater when they themselves are not using the facility. Would that revenue be considered unrelated business income and taxable? I don't know, Melissa, do you want to take that question?
Sure. Having theaters and other entities have other entities or events rent the theater, I guess my first question would be, is the theater debt financed? Another question I may have, and if it's not debt financed, I would think that it would be passive income and not considered UBI. The other question I would have, and sometimes what I see with my clients, is they rent out a portion of their building, but they may provide services to the people or organizations that are renting the building, more than just maybe security or a little bit of cleanup, but perhaps catering. And I would need to delve in a little more to see those services, because triggering those services could create unrelated business income even if the building is not debt financed.
Okay. Thank you.
Karen, can I mention too that also you can look at that 85% rule I talked about earlier, which is it can be time and space calculated, and so that isn't something I would recommend they look at if the property's debt financed to see if maybe they can fall under that exclusion.
Okay, very good point. Another question, as I think that we've seen across the board, is being able to generate that advertising revenue is more difficult in today's world, and that the organization that posed the question said they've been running at really losses when they look at their advertising, their net taxable income for advertisements. How long can you include net losses in your UBI calculations before there may be a consideration as to whether or not this is a true valid trade or business? Does either one of you have a comment on that?
Well, Steve does. Steve is, well, first of all, let's talk about carry forward of losses from business activity. under the current tax code, you can carry forward losses 20 years. So you have a 20-year carry forward period. So that's the carry forward. Now, you can take the position something sustaining losses year after year after year isn't a trade or business, because if you'll remember, Melissa talked about the profit motive. But I'm one of these that I like what we call the statute to run. The IRS generally, when you file a return, has 3 years to come audit it. If you don't file a return, they have forever. So I'm one of these conservative persons that usually recommends keep filing, keep carrying forward the losses just to let the statute run. But again, we talk with clients, and those are some decisions that need to be made. The question is do you have more than 1,000 in advertising? If you do, then technically you have a 990 requirement, unless you think you have a solid argument that you don't have a profit motive. But I like to file, and it's the statute reason.
And I think it's important to point out that the advertising, they're having advertising losses after only allocating direct cost rather than allocating both direct costs and excess readership costs as well. Because the advertising could be profitable and then being reduced by excess readership costs to create the loss and not have the net operating loss to carry forward, as opposed to looking at just the first hoop, if you will, of direct costs reducing the advertising income to create the NOL.
Thank you. Steve, you spoke about the neighborhood land rule, and I know this is a question we see quite often. A question was posed as to whether or not, when you look at the neighborhood land rule, does it truly have to be adjacent property? What if the property is located a mile or two away, and that, you know, they would purchase that property, but they aren't able to build on it right away or even within that 10-year time frame? So twofold question is, would a property that a mile or two away qualify under the neighborhood land rule? And what if they can't build on it right away, that they're not planning on? Can it be converted at a later point in time?
Well, the mile or so away, I think, is a challenge, and the neighborhood is actually defined, and I forget what the definition is. A mile may be too far, and there are different rules for a church versus a non-church. So I would have to get back to you on the mile, because that is in the statute as far how far away it is. That's why I use next door, because it is a distance test. So I would need to look at that unless one of you know off the top of your head. The second part of that is you have 10 years in which to convert that to your tax-exempt purpose if it meets the neighborhood requirement. You have 10 years, unless you're a church, then you have 15 years. And so you do have some time to get it converted. Now, if there is a building on the property at the time that's being leased, that property has to be demolished. I'm going to give you one example. We had a client buy an office building that was being rented. It had a year on the lease, so they let it go the year, and they're going to convert it. But they're not going to demolish that building. They're going to do some leasehold improvements inside, but they weren't going to demolish it. That did generate UBI, because they couldn't, even though it met the neighborhood exception, they weren't demolishing the building. But again, I apologize. I don't know the exact distance. I should have looked at that.
Okay, no worries. With that being said, I maybe will turn it over to either Nicole or Jean, because I believe we're right at 4 o'clock. 4 o'clock Eastern time, I should say. We do have some more questions, and what we will try to do is follow up directly with individuals with other questions that were posed. And I'd like to thank you for participating in our webcast. And with that, I'll turn it over to Nicole or Jean.
Well, thank you, Karen, and all of our presenters. We really appreciate your time today. We've covered a lot of great information, and as Karen had said, if we were not able to get to your questions today, we will try to follow up with you off of line. So the presenter's information is on the screen. So if you'd like, please feel free to reach out with an email as well. So as a reminder, if you have not downloaded the presentation, a link to the webinar recording and slides will be sent within 10 business days. And a copy of your CPE certificate, if you do qualify, will be sent to you via email within the next 4 weeks. So with that, thank you for your participation today. You may now disconnect from the webinar.